From Georgia is recognized for 5 minutes in support of his amendment.
Thank you, Mr. Chairman, and I appreciate you recognizing me to offer what I consider to be a crucial amendment to this oversight. My amendment is fairly straightforward and would add a section to the oversight plan directing the committee to look into the persistent number of bank failures, especially for community banks. Georgia has had over 55 bank failures since 2008, including 2 failures as recent as this last Friday. Today, many communities in Georgia are left without a community bank, and when a bank closes in these communities, millions of dollars in that community's wealth are lost. Moreover, acquiring banks often do not have the ties to the community that these local banks do. They do not know the people and are less willing to extend new credit or refinance existing credit to small businesses, and sometimes this is a result of the loss share agreement that these acquiring banks are offered. Now, certainly many of these banks were poorly capitalized and should have failed. However, now Georgia banks are being penalized for paper losses rather than actual losses. And some of these paper losses are really actually performing loans. In this situation, the bank's core business is strong. Many small business owners have continued to pay back their loans, and the loans are performing on the bank's balance sheet. Unfortunately, examiners on the ground only see the decline in the value of the asset and not that the loan continues to perform and thus requires the bank to raise more capital. This is a vicious cycle that we're seeing in Georgia today. FDIC and other bank supervisors have repeatedly issued guidelines to the examiners instructing them not to unduly affect performing loans. Unfortunately, to no avail, this remains a problem. The fact remains that the flexibility FDIC's Washington office calls for, it is just not being applied in the field during bank examinations. Another serious concern for Georgia is the prevalence of loss share agreements that FDIC gives to those acquiring failed institutions. Under a loss share agreement, the FDIC agrees to absorb a significant portion of future losses, usually 80%, on a pool of failing bank assets in an attempt to entice another bank to agree to acquire the failing bank. Although the FDIC has deployed loss share agreements in previous crises, the FDIC has significantly expanded its use of these agreements since 2008. From 1991 to 1994, FDIC entered into 6 loss share agreements. In 2009 alone, roughly 75% of all FDIC resolutions are involved in a loss share agreement. Reports from my district show that these agreements are quite detrimental to even small businesses. Although loss share agreements generally require acquiring banks work in good faith with customers from the bank that failed, the loss share agreement continues and guarantees the acquiring bank 80 cents on the dollar for any loan that defaults. Once a loan is modified, it no longer is under the protection of the loss share agreement. Thus, there is no incentive for an acquiring bank to refinance loans for less than 80 cents on the dollar that they can get from the FDIC. It is these types of backwards incentives that this committee must examine. Failed banks are one of the top threats to small businesses and entrepreneurs in job growth in Georgia and across this country. And I'd like to urge my colleagues to support this amendment, vote yes, and let's adopt it.
Mr. Chairman.
The ranking